Good morning. Welcome to Market Monday. Well, is it a new bull market? I guess the technical definition of a bull market is a 20% increase from the most recent bottom, which was October 12th of last year. We don't really pay too much attention to the technical definitions, but okay, fine, we'll give it to them. Apparently, we are in a new bull market with the S&P 500 up just barely over 20% from the October 12th lows, and still down about 9% since the all-time high on January 4th of 2022. We'll dive into that in just a minute, but a quick caveat. The S&P 500 is not the only index or market in the world. It's 500 large US-based stocks. What about the largest companies based in Europe and Japan? Still down 8% from their peak in October of 2021, despite being up 28% from its low in late September last year. Or small cap Russell 2000, still down over 25% from its peak in November 2021. What about dividend stocks? Remember? Here's a Vanguard dividend fund for 2022. Didn't go up, you're right, but didn't go down like the S&P 500. See that right there? So what's an investor to do? Chase what worked last year, right? So here's 2022, and here's so far in 2023. You're seeing that right. Dividend fund down for the year, while the S&P 500 is up over 12%. So, number one, investing is not that easy. Number two, past performance does not indicate future performance. That's why there's something called core or strategic asset allocation. It'll be frustrating at times, but markets tend to equilibrate. That's why performance chasing, meaning investing in what worked last year, is tempting, but usually not a good idea. And number three, maybe the most important, the benchmark you should follow is unique to you. Do you have an income portfolio? Great. Don't think you should be moving up and down in line with the S&P 500. Are you diversified across all company sizes? Meaning, do you have some small company funds as well? Or some international companies? Great. Don't just look at the S&P 500. Sure, it's the benchmark, which is why we talk about it the most. But we cannot ignore what we actually own, and that is unique to each of you. There will be periods of time when the S&P outperforms and times it underperforms. We need to be able to participate in both of those scenarios without trying to jump around too much and chase what worked last month or last year. Okay, stepping off my soapbox. With all that said, it's also likely you do own some S&P 500 exposure somewhere in your portfolio. So if that particular index is in a new bull market, how has that looked going forward? This has happened 13 times since 1950. That's almost 75 years. And guess what? It won't be the last. 10 out of the 13 times, the low was in. 3 times, another low happened. 2 of those were in the tech bubble, dot-com crash, and 1 during the global financial crisis of 2008. We can see, looking out 6 months, more often than not, the market continued heading higher. And 12 months out, every single time except 1, during the tech bubble, the market was still higher a year later. Remember, these returns don't include the initial 20% off the low. This starts at 20%, which is basically where we are now, and is on top of the first 20% gain off the low. Is it guaranteed? course not. Are the odds in the bulls' favor? I'd say yes, with some pretty respectable returns to boot. But in the name of balance, something we always need to keep in mind, especially coming off a strong jobs number 2 weeks ago. Look at this. Here are 11 recessions in chronological order, starting with COVID in 2020 here and going down to the 1950s. And here are the number of jobs created during the month the recession started. Yikes. This is why we talk so often about job creation being a lagging indicator. More often than not, at the start of recessions, there's still robust job creation. So that's never really a good indicator and really has no predictive power. And today we'll wrap with a look at the US manufacturing boom going on right now. This is essentially hundreds of billions of dollars in construction spending going vertical. And here's the infrastructure law and the CHIPS Act. Looking by industry, we see there was a jump in transportation equipment right here. Everything else is pretty even. Then we have the big one here, which of course is computer, electronic, and electrical. I think they call that onshoring an entire industry. Thanks for watching our video. Hope you have a great week.